Today's episode is presented by Public. Public.com has just launched its new high yield cash account offering an industry leading 5.1% APY. No fees, no subscription, and no minimums or maximums. That means you can grow your cash with 5.1% interest with no strings attached. It's as simple as that. Again, that is 5.1% interest with no fees. 5.1% interest with no subscription, 5.1% interest with no minimums or maximums, and 5.1% interest with up to $5 million of FDIC insurance. Just 5.1% interest straight up, no strings attached. Sign up today at public.com/Chit Chat Money. This is a paid endorsement for public.com, 5.1% APY as of December 20th, 2023, and is subject to change. Full disclosures and terms and conditions can be found in the podcast description. High yield cash accounts are available for U.S. members only.
Okay, welcome in everyone. This is Chit Chat Money, soon to be Chit Chat Stocks. We recorded this and I think we said Chit Chat Money previously as we're recording the intro later, as we're changing the name right around the time this comes out. So next episode, it's definitely going to be called Chit Chat Stocks. But either way, my name is Brett Schaefer. I'm joined as always by Ryan Henderson. And today we have a fantastic long form discussion with Alex Morris from the TSOH Investing Research Service and Francisco Olivera from Arevilo Capital Management, talking Netflix and the state of the streaming wars. So essentially, this is what we did. We waited until Netflix released their Q4 earnings. Luckily, it was a pretty notable one. Very good report by them. And then we talked about the report. We talked about their long-term plans, and we talked about how they're going to affect potentially everything within the streaming market and the entertainment and media industry. We talked advertising tiers. We talked sports. We talked even a little bit on their video game ambitions. And then we talked about a lot of the stuff and how they've expanded their competitive advantage over the last few years. We're going to get right into it. Ryan, anything to add there? What was your favorite part of this Netflix discussion?
I think my favorite part is the first question we ask, which is, are the streaming wars over? Has Netflix won? And
don't spoil it.
I won't spoil it.
Make everyone listen.
I appreciated the answer, and I think it's timely considering that we have had this discussion with them in the past during the streaming wars, and over the last 3 years, we've talked about it a lot with them and kind of how it's going to shake out. And it feels like we're getting kind of through to the other side. So it's a fun discussion for sure. But with that, anything else to add there?
Nope. I think that's a great way to tease this episode. Without further ado, here's our discussion on Netflix.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Anything discussed on Chit Chat Money by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Okay, welcome in everyone. Today we have two recurring guests on the show. It is Francisco Olivera from Arevilo Capital Management and Alex Morris from TSOH Investing Research. Go check out either of those websites or find them on Twitter if you want more information on the stuff that they do professionally. But today we were talking, I think it's been a couple weeks now, we were messaging back and forth on what to do on a show for media, because you guys follow the space very well. You're probably, I would say, one of the foremost experts, the analysts in the space. And we kind of honed in on focusing on Netflix. And I think it was a good choice because this was a very interesting report for all. I think the consensus was, or is, that they absolutely crushed it. And they are continuing to separate themselves from the competition. So we're going to, for context for the listeners, focus on the Netflix earnings report, focus on their broad strategy, and then how it relates to the streaming wars and the media industry in general. So my first question, and I can direct it at either one of you guys. I think you guys can choose who goes first. Has Netflix won the streaming wars? Are there any competitors left?
Go ahead, Francisco. You know this better than I do.
No.
I mean, the obvious answer is yes. I think there was a period of time, late 2019, Apple TV Plus launch, Disney Plus launch, ESPN Plus, maybe not in the same war as Netflix, but that launched a year before. You got HBO got more aggressive. You had the launch of Peacock, Paramount Plus, probably a couple other small ones. Hulu got more aggressive, bundled with Disney Plus, and content budgets for across the board went through the roof. And at the same time, they stopped licensing for the most part original content and library to Netflix. And that also happened at the same time that right before that pandemic, accelerated with the pandemic, cost of capital was lower, the prospects of us staying at home for extended periods of time or at least the perception was very, very high. The traditional studios also, there was hardly any movie theater attendance in 2020 and 2021 wasn't dramatically better. So many of that product went straight to streaming or very, very, very quickly to streaming. So you had the biggest face-off that you've had in this industry ever when Netflix mostly had it for themselves. And that kind of culminated in early 2022 when they had two earnings reports that were horrific from a guidance perspective or from a growth perspective and the subscriber growth perspective. And, Netflix had to pivot strongly and they started an ad tier, cracked down on password sharing. They cut costs. They basically froze content costs and kind of hung in there and executed. And now everybody else is realizing that this business is a lot tougher, that they can't lose money forever. And many of these streamers have begun to cut costs themselves and start licensing to Netflix, and you're seeing their strength and power coming through. So I think the reaction has been positive, but I think it's been almost 2 years of that Netflix had to kind of, start to execute and focus and move in the period that they themselves called a crisis 2 years ago.
Yeah, and for context for the listeners, or just a little tease, we will be talking the foray into sports, or as the CEO calls it, sports entertainment, as he was trying to be very clear on the call. We're going to talk the advertising tier, and we are going to talk the video game stuff that they really are talking about in the Q4 letter. But I want to ask you, Alex, you do a great chart you post on Twitter, X, whatever we're calling it, every quarter with the Nielsen market share from streaming. It seems like Netflix and YouTube are the big ones there, but I guess in related to the streaming wars question, is there anyone that Netflix needs to be worried about from these direct competitors, or is it just YouTube, or is the competitive field are they just pulling away here as we sit here in 2024?
Well, the interesting thing is, and then first of all, thanks for having us on again. The interesting thing from just looking at the Nielsen data is that the services that have made the most significant strides over the past year or so have been the FAST services, the free ad-supported, typically channels. There's some video on demand, but they have channel components to them as well. So the Roku channels, the Tubis and the Plutos of the world, they've made a decent amount of progress over the past year or so in terms of engagement share. It also coincides with maybe fortuitously for someone like Netflix with the move into these ad-supported tiers and these lower priced offerings to do a better job of segmenting the base. But in terms of the legacy players, they've all, generally speaking, been stuck at similar levels to where they've been for some time. And just for numbers for people who haven't seen the data, if you're looking at a Paramount Plus, a Peacock, a Max, that's right around the 1% of US TV time for each of those services. I believe Disney Plus is closer to 2%, and then you have the Hulus and the Amazon Prime videos, which are more in the 3.5% range, I believe. And then finally you have Netflix and YouTube, which are up around at least 7, 8, 9%. It moves around over time. So yeah, they've really, kind of maintained that clear leadership position over the past, call it 12, 18, 24 months when the industry went through probably its most intense period. The other thing I'd add to Francisco's answer is, I think it's really important in my mind, and we talked about this last time that I was on Chit Chat Money on Netflix. It's really important to understand this business from a regional perspective. And I think what they've done in UCAN over the past year or two, particularly on password sharing and the impact that's had on volumes and pricing, is just such a great example of how the results that Netflix is delivering today are the output of decisions that they've been making for the past 5 to 10 years, and they've played this very intelligently and always with a long-term vision. And the alternative route of trying to compress what they did over 10 or 15 years into a period of 2 to 3 years has proven to be very, very difficult. And it speaks to disruption and how important it is to respond quickly and intelligently when your business is potentially at risk. So this has been a great case study on how change can impact an industry.
Okay. Now, there's been a lot of changes. I guess you mentioned some of them, but what have been the important changes to Netflix's business model since the beginning of 2020? Or you guys mentioned some. What do you think are the most important things that they've changed about this business since 2020 that's allowed them to separate from, as you mentioned, the Hulus, the Amazon Primes of the world?
Look, I think there's some things that changed pretty dramatically, but I think others, I go back to that Jeff Bezos quote that, when you're holding your breath and you're underwater, it's basically you versus the competition. You just better make sure you got the bigger lungs. It's another way of saying that, when you're in an intensely competitive environment, just make sure you can survive, right, that period of time, because it's not going to last forever. So staying with that, right, Netflix had still dramatically bigger global scale than all the competition. They had dramatically bigger content budgets, and a team that's been executing this for well over a decade, and even if you include the DVD days, well over 2 decades. So they had a very, very strong hand, even though subscriber numbers had gone negative and revenue growth had just basically gone down to 1%. So they just needed to hang in there in many ways to keep producing good content at scale. And eventually, with hits, with the content, the smaller players just couldn't survive. The numbers wouldn't work, because if you're every year, 14 billion a year, 14 billion a year, 14 billion a year, and your competitors really can't make a business out of it with 6 billion in content spend, you're just gonna outlast them. So I think there's an aspect of that, but also very, very importantly, they took a good hard look at their business model, and they said, look, some of the things that we thought in the past, we have to change. And the biggest example of this is advertising, right? They were always no way, never advertising. They were very content with, as they say, asking a little bit from their members every once in a while, because they've increased the value to them with more content. And as I look back, and it's obviously very, very obvious in hindsight, but you can't raise prices forever on this type of content. And you have to start to assume that hey, they can charge $30 a month, $40 a month, etc., way down the road. And that just becomes way, way too difficult if you want the type of global scale that we're talking about with 500 million plus subs. Well, they realize that when you have an advertising tier, you can attract a lot of people, right? Offer a very low ARPU, very low price, but their average revenue per user can match that of the ad-free tiers, right? Because you got the advertising coming in. And essentially that means that you have infinite pricing power, as the Trade Desk CEO likes to say, right? Because you get more and more and more engagement, more and more and more subs. more and more ad revenue, right? And that, comes back to your ARPU. And then the other aspect is that, like, look, the password sharing was way too prevalent, and they used, they did a lot of testing, introduced new tech, and they cracked down on that fairly hard. And anecdotally, just I know a lot of people that just have been booted because of password sharing, and they become subscribers themselves. And then when you become a subscriber yourself, right, then you see the ad tier plan. It's just a very attractive option, not for everybody when they've been used to for many years not seeing ads. And advertising, as Netflix pointed out in the call, just opens up the avenue for telecom providers bundling your service with other streaming subscriptions, offering more deals and promotions, because you can take that hit on the sticker price but make it up on the advertising revenue. That's something Hulu has done for many years. So you offer, more price ranges, you bring in advertising. It's a very new muscle, right? That they have to build. They built the password crackdown, technology, and they say it was a huge contributor of the subscriber growth this past quarter, which is, I think, the best Q4 ever with, I think they added over 13 million subscribers. But again, like, just hunker down, have bigger lungs. And they basically froze their content spend, but they kept it very high. They didn't start slashing it, right? And now revenue has reaccelerated. The competition has suffered. They've got an opportunity to license content from others. And now they're seeing double-digit revenue growth again, accelerating, and they have the opportunity to increase content spend again to the extent that they want to. So just a lot of little things, right? But importantly, the scale advantage that they had, right, was something that they continue to use to their advantage.
I know it.
Yeah, to put the numbers on that real quick, because I think it's a fantastic point in terms of bigger lungs and the scale advantage. They came into they ended 2019, so right before the pandemic. Run rate revenues at Netflix were roughly $22 billion a year. As we look to the Q1 24 guidance, that number is now up to about $37 billion a year. And if you look at the main competitors in the space who have been very aggressively invested to try to scale, Disney, Max, Peacock, Paramount, their collective D2C revenues are roughly in that same ballpark. So, Netflix, as versus any individual player, has continued to expand their scale advantage, and they've done it in a way. Again, it's funny to think that the narrative for a long time on Netflix was one of just pushing sub growth and not being particularly concerned about building a business. And it's a laughable comment when you actually look at the ARPU composition of their book, again, on a regional basis, and you compare that to where basically every other major player is at today. It's just laughable. I mean, they've been truly building a business for a long period of time in terms of pricing, and that's something they've certainly hit the gas on over the past 5 or so years, with paid sharing being one notable example. But they have been building a business for a long time, and it's the legacy players who are now seeing just how difficult that is. Again, when you try to compress it into a 2 to 3 year window and have to sustain many billions of dollars of losses to get to somewhere that may or may not be that attractive a business at the end of the day.
You mentioned the ad-supported tier earlier, and then Francisco, you mentioned how it's a new muscle they're kind of trying to have to flex. And I remember reading in their Q4 press release, they talked about continuing to scale their ad business as kind of a big objective. Do you think there's any world in which they end up offering a free ad-supported tier, or is it kind of dependent on how effective their advertising revenue can really be?
I mean, I don't think it's impossible, but I don't see it happening soon either. I think if they built, like, just, every year they have a lot of original shows that are effectively owned by them, or very, very, very long, exclusive deals. If they accumulate, 10 years pass, 5 years pass, you accumulate a lot of content, and maybe, like, season 1 of a show released in 2015 or whatever, you could add in that type of tier. But I think you start to entertain that idea if your scale is on subscribers is just dramatically higher than it is today, and your advertising revenue is at a point where it's several billions. You're reporting in SEC filings, and maybe you're just creating a new customer acquisition vehicle. So it's not impossible. I wouldn't rule it out. I just don't think it's in the near future, but I could be wrong.
Yeah, I think it's somewhat tangentially related, and I think it speaks to Netflix again with long-term focus and pricing the product relative to the value that they provide to customers, and they're being open to new models. But I think again, anecdotally, as someone who has done this a number of times now, if you go to cancel Peacock or if you go to cancel Paramount Plus, they'll dangle offers in front of you for 70-80% off for a period of 3 months. And I think in terms of managing these businesses for the long term and with the right mindset, I just think it's one clear example again of where Netflix is, again, not to say that they would never have a free ad supported tier, but I think they appreciate the value that they provide, and they are willing to be aggressive when it's justified in terms of asking for more pricing. So I'll be surprised if they go direction, just because they appreciate that the value out of their offering is head and shoulders above some of the fast services, as an example.
Okay, as we wrap up this advertising segment, I have one more just to connect it back to the stock and kind of the potential. I don't know, how big can the advertising segment get? They talked about, I think, and you guys can correct me if I'm wrong on the years here, 2024 advertising revenue still won't be relevant. 2025, their goal is to actually have it contribute meaningfully to revenue growth. My question is, given the global scale, given their 10 years, maybe 5 years now of huge investments into markets such as Latin America, South Korea, even India, how big can the advertising revenue get? Are we talking $10, $20 billion in revenue eventually, or is that maybe a bit too ambitious for a business like this?
I'll give a cop-out answer before Francisco goes. I think the big variable that's going to impact this over the next 5 to 10 years is how they truly think about sports. And I wrote about this yesterday. One key detail I thought from the WWE deal, which I'm sure we're going to talk about, was the decision there are not going to be traditional ad slots, according to reporting from CNBC's Alex Sherman. There are not going to be traditional ad slots on the WWE Raw programming. And I think it's a very interesting decision, and it makes me that's for the non-ad supported customers, to be clear, the SVOD tier. I think it's an interesting decision, and I can appreciate why they would choose to do that, given their basically historic branding and point of differentiation from linear television. That's going to be much harder to stick to, I think, over time if they truly want to get into a broader sports portfolio. So I think answering that question is pretty darn important in terms of just figuring out what type of content they're going to have, but then also how much ad revenue they'll derive over time.
Yeah, I think my quick answer is the potential is extremely. I wouldn't be shocked if we're looking back down the road and they actually can get to 10 billion. But to answer that question, I mean, they really have to increase the penetration of the advertising subscribers as a percentage of all of their subscribers, right? So right now, I mean, I would guess that the advertising subscribers is maybe definitely under 10%, maybe even under 5% of subscribers, depending how, they have, I think some report out there, 20 million monthly active users on the ad tier, and there's more users, more than one user per account. Just depending how you're looking at that. So I think some of these other services like Hulu, that's in the billions in ads, even Peacock, that's growing ads well, right? I think it's 2/3 of their subscribers are probably in the ad tier, and that's where you can get real muscle, because you get scale the number of users and the level of engagement. So they need to focus on penetrating that, and I think they started to signal the last few quarters that is their goal. And one of the ways we're going to do it is that they'll probably be aggressive in raising prices on the ad-free tier, in a way that as they went through this period of the streaming wars, right? They kind of stopped increasing prices as much. Now they're going to return to, they had the password crackdown, they had the ad tier. Now they're going to return to increasing prices a little bit more aggressively. It's like, hey, if you don't want to pay, just to say a number, $18, $19, $20, then there's a $6.99 option. And I think you're going to be able to migrate people and acquire more people. And I think 40% of subscribers, 40% of gross ads, is it 30 or 40% of gross ads, Alex, that they mentioned last quarter that in the ad tier markets are getting the advertising tier?
Yeah, 40%.
40%. 40%. And I think that number was 30, was 20. So they've been scaling that penetration. So that's what they got to be focused on. So every time you see like, hey, price increase in the US, I think that's another sign that they're trying to push more and more. They removed the basic tier, which was, I think, $9.99. They're starting to move that in many markets. So they're very, very focused on this business being big and working. And additionally, to Alex's point, which I think was a great point on how they get into sports, I think that's going to be a big part of it because, if you have WWE programming and they got the rights now, and you get Coca-Cola to, let's say Coca-Cola really wants to advertise for Netflix on WWE globally, right? Big global brand. Netflix is going to say, like, yeah, fantastic. We'll give you premium spots or whatever, but you also got to advertise on our normal, on Squid Games, on other originals that they're releasing, right? Casa de Papel, etc. And that's a trick that Disney has done traditionally. Like, hey, do you want Monday Night Football? And you got to give me inventory for ABC and FX, etc. So Netflix is going to start playing that game, and I think it's really helpful to have properties that are captive audience. So the more you see them getting into live and things like that can work well for advertising, I think the more it bodes well. So, but yeah, on the point that you said earlier on the different muscle, it's just, acquiring advertisers is just one muscle. The technology, is another. The customer acquisition, is another. Ad formats is another. So it's just a completely new business, and something Rick Peters says, institutional knowledge and expertise that they've had to build, in basically over 2 years, and it's been pretty impressive to see how they started to build. It's not material yet, but I'm sure like over the next few, probably quarters or maybe a year and a half or so, we'll start to get real hard numbers reported by the company.
Yeah, the only other thing I'd add is I think aspiring to build a very large ad business is fine, but I also think it's important to keep the eye on the ball of just building a large business overall, right? And I mean that in terms of the user experience, the product, and maybe this is a little bit of too much of a pure view of Netflix back in the day, but the product experience when there's no ads is, I think the vast majority of people would agree, is better than when there are ads. And when you introduce the ad component in terms of not just the quality of the product, but the value equation, you start tinkering with things like engagement. And my point in saying that is if Hulu or Peacock, whoever it is, has 75% of their customers on the ad tier versus 25 on the subscription tier with no ads, I personally would hope that Netflix would have a subscription mix that's quite a bit higher, and being representative of the fact that it is the default service for people and they're willing to pay the full price in order to spend more time with that service, as opposed to some of these secondary and tertiary products that they may use, but they're not going to be where they start the experience every night. Because I think that is a hugely important part of Netflix's business model over time.
We've alluded to the sports rights a little bit throughout the show, so why don't we talk about that? The Netflix just announced sort of a pretty big deal, it seems like, with the WWE licensing agreement. Can you guys maybe go through some of the actual terms here? So like what does the deal look like? Why do you think they did it? And how will it impact the other media players?
Do you want to take that, Alex, or do you want me to take it?
Why don't you start on deal terms, because you're the TKO expert here.
So deal terms is you think about WWE, they have 2 weekly properties, right? SmackDown on Fridays and Raw on Mondays. In addition, they have the premium shows like Royal Rumble, WrestleMania, that there's another package and they call the PLEs, premium live events. Domestically, the SmackDown rights they renewed with USA Network. It used to be on Fox. And Raw, they just renewed with Netflix, right? The PLEs are with Peacock, so WrestleMania is on Peacock. So that's the big component of it. They renewed Raw with Netflix, but they also did a deal with Netflix as part of it that for the vast majority of global markets, not quite all of them, and not immediately because some of these deals expire over time, Netflix is going to acquire the rights to Raw, SmackDown, and the PLEs, so the WrestleMania. So they're basically going to have all of WWE content, including original programs, documentaries. It's going to be added to Netflix, internationally, and domestically they're going to have Raw. So it's a 10-year deal worth over $5 billion. So call it on average $500 million per year. But Netflix can opt out after 5 years, at year 5, or they can decide to extend the deal for another 10 years. So potentially you're looking at a situation where Netflix has, WWE Raw domestically, and most of, or practically all the WWE content abroad, for 2 decades. So it's a pretty flexible and advantageous deal for Netflix on the economics. But if it works out, it's a very, very good deal for Raw because you're exposing WWE content is the bread and butter is a younger audience, right? The younger audience is not watching linear programming, and it's declining. It's declining with adults. It's declining way even faster, or even more dramatically with young kids. And so you're going to open the audience, and the younger audience, the tech savvy audience, the growing demographics of WWE fans, and on Netflix, and you're going to give us huge exposure. They've done this indirectly or directly, I guess you could say, with other sports leagues, with most famously Formula One, how a documentary just exploded the growth of the sport. Well, they have an opportunity now to explode the growth of WWE by giving it, the biggest streaming platform in the world. And I think WWE management said, like, look, we can talk about some of the economic terms, but we're basically not getting the best deal on a dollar basis. It's a good deal on a dollar basis, but it's not the best deal on a dollar basis. But we're going to take that because we are going to have the biggest audience of streaming in the world. And most households, or many households, check Netflix daily or weekly, and they're going to be exposed to WWE. So it's a big opportunity to expand the sport, the sport entertainment. I guess it's scripted. So those are the rough terms of the deal.
It's scripted? No way.
All right. Alex, do you want to maybe talk about any opinion on why they did this specific deal, or how it could impact other media players? I guess one thing that comes to mind is that in the United States, the sports licensing stuff for the traditional cable bundle is the number one thing that keeps people around. Does adding that, more and more sports or sports entertainment, as you might call WWE, to these streaming platforms, does that potentially accelerate the decline of the cable bundle? That's kind of what's in my mind when talking about Netflix, this deal, and any other future deals with them.
Well, if the legacy U.S. media companies are worried about that, then they should probably stop doing it themselves. They're doing a fairly good job at that currently on their own. And just to put that in numbers, I mean, Comcast reported this morning which I believe is still the largest MVPD. I could be wrong on that, but that they've lost past 5 years, they've lost 8 million pay TV customers. And that was it. So it's down 35% over the past 5 years. And the majority of that declines come in the past 24 months. And, the reason why is it's due to price. It's due to competition, in my opinion, aka, a service like Netflix, which has been eating their lunch for a long time. I looked yesterday at Comedy Central's programming guide for the day. It was like 9 hours of Seinfeld, and obviously that has ads, and you don't get to pick what episode you're watching. And then, it went to some other show like Netflix for the next 9 hours. I mean, it's just the value is obviously not there anymore for anything that's not news or sports. And then when you look at sports specifically, you can, look at what Paramount's done with their NFL rights or what Peacock has done with their NFL rights. Most notably recently was the wild card game for the AFC wild card game, I believe. So yeah, they've done a fairly good job of that on their own. So they don't even really need Netflix to help. More broadly on the deal with the WWE, I think it is the content is particularly unique in terms of being sports entertainment. And I think that distinction is meaningful in my mind relative to other properties like NBA and season tournament or something. I think the other major point from the conference call, as said by co-CEO Ted Sarandos, was in terms of the value that they brought to the table for the WWE in terms of global reach. And, I just think it's a very important comment because it speaks to management's understanding that they're only going to play in these things when, in my opinion, they're only going to play in these things when they can truly add something incremental to the equation from what exists currently. And again, in many cases that probably will not apply. And the deal value here was also smaller, so it made it a nice place to start out. But I think it's a deal that makes a ton of sense for both sides. And I think TKO really deserves a lot of credit for going out and doing this, because I think in hindsight it will prove to be a very smart deal, even though it may not look that way in terms of maximizing top dollar tomorrow.
Okay, now, since this is a podcast, I want to do something a little more speculative. Do you guys think one of the big, why don't we just call it the big three, or really at the end of the day, it might even be the big two sports leagues in the United States, NFL, NBA, and then to a lesser extent, you have Major League Baseball and National Hockey League. Do you think any of those games, playoff games, whatever, will be on Netflix at any point within the next 5 to 6 years? Or how about we say by 2030?
I'd say there's a good chance that you'll have some. But I think the one that makes the most sense, in my opinion, is at least like a slate of games from the NBA to Netflix. And there's been reports that they're interested, or at least in preliminary interest, in the in-season tournament. The reason is because the NBA is the most global out of all those leagues. And you can package something that is impactful and meaningful, but it's not necessarily like your average kind of weekly game that maybe is not as valuable. So I think that's what makes sense, because if you look at WWE, right, it's global, it's weekly, it's live, opens opportunities for advertising, potentially opens opportunities for merchandising and video games. There is a big on-demand audience to WWE as well. Not necessarily something that, like, hey, an NFL game ends, unless you're a super freak, or especially an NBA game, you're not going to want to rewatch it, right? Especially when there's proliferation of highlights everywhere across social media, YouTube, etc. But WWE people do watch it on demand and catch up, right? I couldn't necessarily be in my house from Monday from 8 to 7 to 10 or whatever when Raw's on, but I'll watch it in the morning, the afternoon, the next day, whatever. So WWE touches a lot of those boxes, and the NBA, also touches many of those boxes, not quite as much, but particularly on the global nature of it and creating an event around the in-season tournament. You're talking about the NFL. Yes, it's expanding globally, but the interest is not quite there to that degree. They could definitely help expand the global audience. Maybe something more interesting is an NFL deal outside the U.S. Quite frankly, for Netflix, because you're not necessarily going to expand the reach of the NFL domestically in any big way. Like people go out of their way to find the NFL, and the NFL, your local NFL is always going to be available for free on over a broadcast channel, and the NFL is very religious on keeping that. And Netflix, I'm not sure we want to compromise on that point. As you get down to the other leagues like MLB and NHL, they just become ultra local or very, very local. So you don't necessarily like, and many of those teams have their local rights to themselves or tied to RSN. It's a bit of a mess. So I think for leagues, again, global nature and marquee events, I think it makes a lot of sense for Netflix. And, there was talks that before they were, interested in potentially surfing, interested in Formula One, now WWE. I think something like Wall Street Journal reported boxing. These are things that have global appeal and more broad appeal, and something that they could help grow significantly and take advantage of. So long answer to your question. I think out of those major leagues, I think I would put the odds higher on the NBA. But the other leagues, like, never say never. There's always ways to, carve out these deals, but I think it's a longer shot unless Netflix starts to have a very, very, very big portfolio of rights.
One follow-up there. Oh,
yeah.
Sorry. One follow-up there. The NBA is supposed to renegotiate, or excuse me, not renegotiate, do its new deal this year, correct?
Yes.
Okay. All right. So we could see some news on that.
We could see some news. I think the exclusivity, there's a exclusivity period with ESPN and Warner Brothers. And that, I think they're speculating. I mean, I don't know, the exact date might be out there. I think that might end in April or toward, the middle of the year. So I think you'll see things heat up, towards the end of the NBA season, potentially the off season, to see, middle or second half of this year, to see where the bids come. So, and they've said again that they're going to carve out the in-season tournament and potentially carve it out globally. So we should get some news there. And by the way, just one more quick thing. There is interest from Amazon, other streamers. I think Amazon acquired some NBA rights in some markets, and I followed this situation closely with the WWE. A lot of people thought Amazon was the front runner for the WWE rights. Netflix ended up getting them, so it was kind of out of left field in many ways. And I think now people have to be a little bit more respectful if they're involved, including other streamers, not just your traditional media players.
Yeah, I can't remember if I mentioned it already. I may have, but the Sarandos quote on the call that he would not look at this as a change in their sports strategy, and it ties in well to the NBA, the new rights deals coming up here fairly soon. So to the extent that they do plan on playing there, that would he's going to have some questions about what he said 3 to 6 months ago very quickly. So I really think this statement, and it's similar to what they have been saying on acquisitions, right? I think they pretty clearly said for the past 6, 12 months, whatever it is, that they're not interested in acquiring anything that's not a good strategic fit with their business. And this quarter, they came out for the first time and just very directly said, we don't want to acquire linear channels. And I think sometimes what they say is put through a filter of like trying to figure out what they're really saying. And I think sometimes they're really just saying what they're saying. And I think there's certain things like, I think Francisco framed it well. They will be interested in things that probably have global appeal and in ways where they can add value And, something like US NFL rights is, in my opinion, not where that's going to happen.
What would sports rights look like within the service? Do you think it would just be a part of the existing kind of premium subscription tier, or do you think it's something? I think it was either Francisco or Alex that mentioned that they're not going to do traditional ads within the WWE service. If they're doing something with the NBA, would that pivot? Would that switch, or do you think it would replicate kind of this WWE model?
So I think that's the problem is the question, right? This is what's happening now. I mean, you can look at Zaslav's the perfect example, who railed against the model of renting sports rights for many, many years when he was at Discovery. Now that he's in charge of WBD and has a huge book of sports rights, he's forced to navigate this question of what do we do with this in an environment where the largest pay TV distributor just saw its customer base decline by 35% in 5 years, and that pays our bills and the cost is rising. How do we transition from A to B? And, I think what they've announced recently with I believe they're still calling it BR Sports. I know they changed the TNT branding internationally, but I think it's still BR Sports, which is going to be an add-on tier onto Max after they get through a little bit of a free trial period here to get people to hopefully start using the product. I haven't heard too much chatter in terms of people actually doing that, but that it's not an offensive decision. It's purely defensive, and it's purely trying to figure out how to sustain these economics. And the answer to that question is going to be very, very difficult. And by the way, ESPN and ESPN Plus have a similar issue here, and they've come about it in a somewhat different way. But I think they're also finding now, as this evolves, that getting to the answer is very, very difficult because these rights are very, very expensive. And, putting it in an all-you-can-eat product is inevitably going to drive up the cost quite significantly, which for a certain customer that's going to work very well, and for a different type of customer that's going to be very problematic. So I think Netflix will tread very, very cautiously before they move down that route. And I think there are clear opportunities for them to add value to suppliers that can work better for both parties. And a good example is, a 20-year deal with the WWE.
Yeah.
Okay.
I just want to add, I agree with Alex. I think, adding tiers and all this stuff and mumbo jumbo, and particularly when you have issues with when Netflix has issues with the in-app purchases with Apple and all those things, I think it becomes a little bit too messy. I think, especially when, this year the content budget is $17 billion cash. WWE starts in 2025, and it's $500 million. So it's material part, but not, not something that's going to drive your cost of programming too dramatically. So it's much simpler to keep it. I think another perspective is in the user interface, how is it going to call to attention, and you're going to, WWE provides a lot of content. How do you organize that? I think, I'm not sure what they'll do, but they're the best at user interface and tech and looking clean and organizing. So I trust that they'll find a good solution for the WWE and that from that perspective.
Okay.
Real
Next
quickly,
topic.
one more thing.
Go ahead. Yeah, go ahead.
Just one more thing, and it ties back to the prior point on engagement and having this be the service that people pull up every night, right? So there's certain things like an NFL playoff game that people are going to seek you out and find you. When you own the out-of-market rights like ESPN does, getting that in front of people, there may be plenty of people who are willing to watch a random game that they don't know is on, but you have to actually get that in front of them somehow. They have to know that it's on. And, this is where you get into issues that they have been navigating and will continue to navigate, like they've done very prominently with ESPN Plus basically being a row of tiles when you open up Hulu. These are the things that you have to think about and have to build the business around. And again, if you're driving a huge percentage of your sub base to a lower priced ad tier where they're not as actively engaged, or not opening the service as much on any given night, these things will matter over time in terms of the economics on those rights. So it's all tied together in a way that is particularly messy for the companies that are trying to make this transition.
So in the Q4 letter, they led things off with saying they want to broaden their offering with 3 different things. First, live. Second, sports, which I guess relates to live a bit. And then the third one was gaming. Gaming, if you're not following Netflix closely, may surprise some listeners. I'm sure a lot of people don't even know that they have the games there. They've kind of been testing the waters for the last 2 years. Either of you can start first. Why do you think they are interested in gaming, and why now? This is a hard one. No one. I know you guys don't like this question.
I think. Look, I'll start. Well, they've been at this for, over 2 years. I think at this point, since they announced their initiative and started building it, and they hired one of the top gaming executives from Facebook, now known as Meta. The reason why they started, right, is because they see, they label competition as, sleep, anything that takes away attention from them. And as you look at the younger audiences, just gaming, and even growing older audience, gaming is just a big part of your daily entertainment. And if you're highly engaged with a game, let's say on a console or mobile or PC or VR, right? That just takes away time. If I sit down in my bed and even like playing chess on my phone, right? That just takes away time that I could be watching Netflix, let alone if you're on Call of Duty, Fortnite, et cetera, younger audiences, Roblox. So they know that is a threat to taking, attention away from them. I suspect that's why they thought it would be interesting to them, but also a way that they could, we were talking earlier about sports and bundling a part of the entire cost of the business being together. Well, potentially gaming can be a part of that. With your subscription, you have games, and they said it hasn't been really a tool for acquiring customers, but it's been a decent tool for those that have used the games to retain customers. And then as technology evolves, cloud computing gets more advanced, internet speeds improve, et cetera, you can imagine a world where we're streaming games like Roblox has done. It becomes way more ubiquitous with high quality games, and you can imagine ways that that happens directly on your phone. You don't even download the game, just play it on Netflix app, but also on your PC. So it's a very, very long-term bet. Greg Peters talked about in the Stratechery interview that they're putting a big investment, meaningful investment, but they're also not like super rushing to it because they got to build the institutional expertise and know-how. It's not just about hiring good people and off you go. They've acquired small studios. They've licensed different shows, games. But it's also a benefit with their own, intellectual property and content. And even I think one of their biggest hits in games was based on one of their reality TV shows, right? They also licensed the Grand Theft Auto games, and that's been their biggest downloads ever. And it was at one point, top of the Apple game charts. So I think it's a place that they can scale over time, be meaningful, be a big player, and it's medium of entertainment that's just growing dramatically in the time spent that people are consuming this. So and eventually they'll leverage their IP, you can imagine a situation where they're super advanced, or they're in AAA games, which are the most high quality games. And they'll have a AAA Squid game, right? Pristine production with voice actors and audio quality and graphics and the sophistication of the gameplay, all over, and with playing with friends that are also Netflix subscribers across your phone, television. That'd be like the home run super scenario, right? But it takes a long way to get there, and I think they're building the muscle, but I think they're also doing it in a way that it's not really hurting their free cash flow growth. It's not really, they don't have like another segment that's just burning a a lot of money and slowing them down. But they're putting good attention to that. That's why I think they mention it a lot, even though it's really not material to them. I think they mention it a lot because they want this to be much more important over time, and they want investors to know this. They want their management team and employees to know this. And so I think it's going to be a bigger part of Netflix, but it's a much more longer term play, right? I don't think next year is going to be a crazy change from last year. You might have more tonnage of gains, but I think it'll take time to really crack that code, because they don't want to look a very costly AAA game can be in the hundreds of millions of dollars, right? And you got to market these as well. And they don't want to start at that level, because then you risk yourself of blowing up or blowing a lot of money away. And that's happened to Amazon. They spend a lot of money on trying to go to the AAA segment very, very quickly, and you stumbled, right? And they're rethinking their gaming aspect. So I think the way they've approached this is good, but I would call it like a call option as an investor in the company.
Yeah, I mean, I basically have the same thoughts. I think I think it makes sense in terms of time spent thinking about what entertainment is and how that continues to evolve. I think there's clear benefits in terms of sustaining and driving popularity of key IP. And I think they said that, the quote about this on the Q4 call, I think pretty well said that that's where their focus will be going forward, which makes a ton of sense. I think there's continued evolution technologically. We've seen things like Google Stadia and the like, and it's not hard to imagine a scenario where the ability to interact with Netflix's gaming services, beyond just mobile usage, which I think is the primary, if not sole way to use it today. So I think it's an area that makes a lot of sense for them to explore and to get their arms around. And again, I think it's something like, not to say it will become this, but it's something where if it does become a meaningful part of their business and what people kind of demand or want as part of the value proposition, they'll be many years ahead of competitors who are, they're obviously doing things with gaming in certain ways that traditional media companies, but they're not taking the same approach in my mind, or anything comparable to the approach that Netflix is taking. So it's I think it's a very reasonable bet that may or may not work out.
Okay, let's kind of shift gears a little bit to discussing Netflix stock more specifically. They just had their earnings report. I guess as of the time of this being released, it will have been about a week prior. So thoughts on the guidance for 2024? What do you think about the valuation at today's price? And then I kind of as a follow-up, you talked about the Nielsen engagement ratings earlier in the episode today, and I'm curious, the CTV space as a whole is growing. Do you think Netflix needs to grow their share within the space in order for this to work, or can it just maintain its position?
I can start on that one. Yeah, I've been tracking, for anybody who doesn't know, I've been tracking Netflix's share within CTV or within streaming as part of the US is the region where we have the clearest data on this. And for basically as long as it's been reported, they've been in that, call it the 20-25% range of the broader market. And the broader market's gone from, correct me if I'm wrong, maybe 25% to now pushing 40%, mid 30s. So I think they can do quite well if they kind of sustain that level of share. That said, I would expect it to start moving higher over time. And depending on how you think about what YouTube is and whether it's a competitor or just a different type of offering, obviously the numbers would look quite a bit different as well. In terms of the stock and the way the business is valued, I think part of the reality, and it's kind of as we discussed today, is that the level of certainty in this business, in my mind, is even higher than it was 2-3 years ago. We just went through a very significant test of the sustainability of their competitive advantages, and they came out quite well on the other side. I think if you looked at the valuation 18 months ago or 24 months ago and asked what's priced in here. A lot of the answer would come down to, do you believe that this is a business that's going to be capped at 225 million paid subs at $10 a month, or is this something that's got room to run on both of those variables? And we've come a decent way on the volume part of that equation subsequently, and I think we're very well set up for both legs to keep moving higher over time. So yeah, as always, it depends on the assumptions that you're willing to build in, and also the type of investor you are and your time horizon. But I think the company's position today is as strong as it's ever been, and while they say they are not interested in acquiring linear assets, which I think is almost certainly the right decision, that I do not think that will preclude them from finding other potentially interesting ideas with legacy content owners or content production engines. So I think there's certainly more to come in the months and years ahead.
Yeah, I completely agree. I think, look, if they had 6.9 billion of free cash flow last year, effectively guiding to 6 billion in free cash flow this year. Reason why it's down is because we had the actors and the writer strike last year for a long period of time, which was $1 billion impact. So all production and development of content was shut down for many months, and obviously they saved $1 billion, and now you restart development, you restart production, so there comes a swing there. And I thought the swing would have been higher, quite frankly. I thought, they had 6.9 billion free cash flow last year. I would have thought maybe it would have been 5 this year, but it's going to be 6 billion free cash flow this year. And then if you go, well, 6 billion free cash flow, it's basically roughly 40 times free cash flow. And then you look at that, you're like, okay, highly certain of their path, subscription business, but still a very, very, very high multiple. The flip side of that is that, look, now they're growing at 12 to 13%. And this year, advertising is not going to be material to their growth, but it will be in 2025. So you're going to have a decent, and the password crackdown and is contributing to subscribers. And now you basically have the best options of licensing and producing your own original content that you ever had before, because before nobody would license to you. Now, like, look, they just added, they just announced that they're going to have, or it was reported that they're going to add Sex and the City, right? Something, a property that I think, 2 years ago, you would have said the odds of that going to Netflix were like nearly 0%. And now they have access to this type of licensing opportunity. So the path is very, very high, but also look, if they can sustain even low double digit, revenue growth, and they got to 17 billion of cash content spend this year, look, Alex said, like, near 37 billion in run rate revenue, slap a 10% growth on that. Let's just, round up the numbers a little bit. So incremental revenue of $4 billion. You're not going to raise your incremental content cost by $4 billion from 17 to 21, right? It's just not going to happen. And you can be much more, you're spending 17 billion. The competition is cutting costs, and you have the access to license most content that you want globally. You don't really have to put down the hammer on content spend. So they talked about that they were willing to play offense, reinvest in the business, grow that, but you don't got to grow it in a dramatic way. My point being that you got a 4 billion incremental revenue growth on a run rate basis. Just as an assumption, an example. Could be higher, could be lower. You're not going to grow content costs, which is your biggest cost, anywhere near that. And that creates pretty high operating leverage that goes down to free cash flow. In other words, that 6 billion of free cash flow can swing to 8 billion very, very quickly in a short period of time, 10 plus billion in even faster, in a medium term time range. And that multiple that we're talking about this year starts to look, fairly low for such a high quality business if you're looking down, let's say 5 years from now. So I'm not saying the stock is cheap. It's full. But their competitive position is so strong. The nature of the business being largely subscription based, and their competitive position in terms of subscribers and usage. We might look back 5 years from now, and today might be a pretty decent price. But there's always volatility. Hey, you miss subscribers by this much, the stock tanks. You beat subscribers by a little bit, stock goes up a lot. So there's always going to be a lot of volatility here, but I think they're extremely well placed.
It's hard to. Just one other thing I'd add on that is thinking about some of these assumptions going forward, and obviously it's hard to really put this to an apples to apples comparison, but it is interesting to think about if you pull up Netflix tonight when you're at home and just look at the breadth of content that's on there. And obviously it's, depending on the tier you're on, it's all accessible when you want it, where you want it, obviously with no ads if you're on the SVOD tier. And you look at that business, and in the United States or in UCAN, the ARM, average revenue per membership in the fourth quarter, was just shy of $17. You can compare that to what I was saying earlier about Comedy Central, where you can turn on your TV right now and your choice is to watch the episode of Seinfeld that's currently on TV, and it's a 22 or 23-minute episode with 7 or 8 minutes of ads, and when that ends, they'll air the next episode that they decide to air, and that'll be 22 or 23 minutes with 7 or 8 minutes of ads. And if you look at Comcast's results for their cable business this quarter, their programming expenses are roughly, these numbers are getting harder and harder to calculate cleanly because of the pace of the decline, but their programming expenses per sub are roughly $75, which is quite a bit higher than it was 5 or 10 years ago. And that's just their programming expenses, right? They're still pricing at least for some growth margin on that to cover their OpEx. So point being, the cost of that Netflix subscription, or at least the ARM, is, maybe 1/5 of what the average pay TV subscription costs. And, there's obviously differences between those two products, most notably in terms of sports and news. But I think it just provides some context for what you're getting relative to, what you would have paid 5, 10 years ago, 20 years ago for Redbox subscription or rentals, Blockbuster rentals, et cetera, et cetera. The value add here and the improving value add here, in my mind, is not reflected in a $16 UCAN ARPU, nor is it reflected in a $10 global ARPU. All
right. We've been optimistic, rightfully so, on Netflix on this discussion. They crushed it with their Q4 earnings, but I want to, as we always close out with any stock-specific discussion, talk about a pre-mortem. So we're not going to talk, clearly the stock's premium valuation when looking at its trailing numbers. People can debate whether it's a buy or not here, but I want to talk about their underlying business and market share. So what would have to happen for them to lose market share, let's just say in US streaming TV over the next 5 years? Who could come in and steal market share from them? How do they lose relevance to the North American customer?
I think that the way I would answer that is more about the losing relevance part. I think, when you have young kids just on YouTube all day long, and very, very young kids, and then when you have a slightly older cohort, on TikTok all day, and you create those habits and the proliferation of social media. I used to think, and then you go older. So I used to think when I was in college, looking back, if I had some free time between classes or after studying or whatever, I would binge a bunch of shows. Now you might, I'm not sure, maybe I'd be flipping through Instagram for like 30 minutes and then then doing something else. Right. or now TikTok or whatever, or playing more video games. Even though back then, still played a lot of video games, but just the entertainment industry, and there's many more ways to be entertained, and I think that's something that is more of the bigger risk. And it kind of ties into kind of like the movie industry overall, like in the 1960s, right? 70s, 80s, even 90s, I used to wake up as a young kid and like check the newspaper to see the scheduled times for certain movies. And it was like, oh my God, it's gonna take them forever to watch this after it's gone out of the movie theaters if I wasn't able to watch that movie. And then you gotta go to Blockbuster or buy the movie. Now it's just like, well, to go to the movie theater, like it has to be something so impactful, like a Barbie moment, right? A Top Gun moment, a big Avengers movie moment, just like these special, unique. It's like genie in a bottle type of thing. So it just becomes harder and harder and harder and harder. I think that would be the bigger risk, and particularly kind of YouTube, social media, whatever is going to come next, because there always will be something next. I mean, pre the pandemic, not a lot of people knew what TikTok was. So it just keeps evolving, and that I think that goes to show why they're expanding their horizons with gaming and live programming. They can't just sit there and be like, hey, TV shows and movies, right? They kind of have to keep expanding and pushing their boundaries, because it's just entertaining people just becomes way more competitive over time, right? I mean, people used to go to theater and drive-ins, and then things change. So the entertaining people evolves, and I think that would be the bigger risk. I wouldn't necessarily say it's like another streamer toppling them. You can't rule that out, right? I think if I'm looking at it over a very long period of time, I think that's the risk that I would point to.
Yeah, the one that as Francisco mentioned, the one I personally focus on the most, and I see this from tracking the Nielsen Gauge data, and then actually when they reported Q4, they had a chart in there with some other country-specific data, and I immediately pulled up the last Q4 letter because it had the similar countries, Poland, Mexico, et cetera. And what I wanted to see was the YouTube share in those markets and how that's trended over time. And YouTube is a extremely popular platform in the U.S. and even more so globally. Would probably be my guess based on the data that's reported. And by the way, this is typically TV data, at least in the United States. In other markets, it is inclusive of mobile and whatnot. But the idea that YouTube's dominant, obviously, on the TV form factor, you would think that would suggest they're much more dominant when you properly account for mobile, whatever it may be. And I think back to there's a comedian, Tom Segura, and he mentioned, I think it's his book or on a podcast at one time, that it was 2013 or 2014. He was talking to his agent, and he was really hoping to get his special on Comedy Central. And he called him and told him, yeah, we didn't get the deal, but it's going to be on Netflix. And he was, kind of disappointed. It's like, oh, I guess we're going to that crappy DVD service, which at this point already had streaming, but maybe he did or didn't know that. And what he found subsequently is that his ticket sales exploded, and he's like, oh my gosh, this is a much bigger platform than I realized. And that was 10 years ago, when he would have preferred to have bet on Comedy Central over Netflix, which nobody would say today. And I would just note from following comedians that many who do not sign deals with a Netflix, or I guess HBO to the extent they do this at all anymore, a lot of them throw their specials up on YouTube, and they get very significant viewership. And there is a component of their overall economics, or the way they think about their business, that makes that probably a pretty compelling platform to consider using. And I'd also note that YouTube was had a strategy that focused on more premium content a handful of years ago. They subsequently exited that, and and not revisited as far as I know. But point being, YouTube is a very dominant platform in a lot of ways, and there's nothing written in there's nothing that says they can't reconsider how they want to play in this space. So I think they are a very real competitor in a lot of ways, and they and Netflix both are competing with each other.
All right, guys, this has been a fantastic discussion. I think any listener now has a much better understanding of the Netflix business model, where they sit, why they've been winning so much over the last few years. But before we go, where can listeners and investors find you guys, and maybe talk about, now this is a longer form discussion, but you guys do your 10-minute, actually, you talk about it, I forget the exact name, but what have you guys been doing on every Friday morning?
So I'll just quickly say you can find me on Twitter, but you can find Alex on Twitter as well. But he writes an amazing newsletter, Substack, and I think it's very unique and insightful. He covers different companies, talks about investment philosophy, talks about his portfolio, which you can track, and whenever he buys or sells something. It's a very, very unique service. And I'm really happy to be associated with him in our weekly podcast called TSOH Weekly. And we just discuss about any company that or situation that kind of is interesting to us, but we cap it at around 10 minutes, and it's a quick discussion and forces us to like hone in on what's important about each issue. But I wanted, Alex is a very humble guy, so I wanted to make sure to really to promote his service. We can attest to that as well. We are happy subscribers and love reading the TSOH Substack.
Netflix update. This will be out the week after, but Netflix update did come out this morning, so also timely stuff in the updates.
Very much appreciate that. It's called TSOH Weekly, to be clear, because Francisco and I could not think of a better name. He does. Most of the thoughtful analysis and great insights come from him on the podcast, not me. I mostly just sit there, which is fine by me.
That's not true.
The other thing is, for anybody who listens to this podcast, you may recognize the reason we had to constrain it to 10 minutes is because we tend to run our mouths a little bit when we find a topic we like. So we decided to cut ourselves short at 10 minutes every week. But yeah, you can find me over at the TSOH Investment Research Service or on Twitter at TSOH_investing.
All right, beautiful guys. Let me hit the disclosure and we can get out of here. Ryan and I are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast. We may have held them in the past, and we may buy, sell, or hold them in the future. Thank you, everyone, for listening, and we'll see you next time.